Interest rates, they shape our lives more than anything else, from the mortgage rate and the credit card debt to the whole economy, unemployment, and stock market valuations. Let's see what Warren Buffett says about interest rates and their effect on stock valuations.
You've got to crank in interest rates because everything in valuation gets back to interest rates. And interest rates are like gravity in valuations. I mean, if interest rates are nothing, values can be almost infinite. If interest rates are extremely high, that's a huge gravitational pull on values. And we had that in the early 1980s.
So far, we have understood the basic concept of low interest rates equal high valuations, and high interest rates mean lower valuation. Let's see why.
Buy a 30-year government bond. It has a whole bunch of coupons attached. In the old days, it does now. It's electronic. But it has a whole bunch of coupons. And the coupon says 3% or whatever it may say. And that's what you're going to get between now and 30 years from now, and then they're going to give you the money back. What is a stock? A stock is the same sort of thing. It has a bunch of coupons. It's just they haven't printed the numbers on them yet. And it's your job as an investor to print those numbers on. If those numbers say 10%, and most American businesses earn over 10% on tangible equity. If they say 10%, that bond is worth a hell of a lot more money than a bond that says 3% on it. But if that government bond goes to 10%, it changes the value of this equity bond that, in effect, you're buying. You are buying, when you buy an interest in General Motors or Berkshire Hathaway or anything, you are buying something that over time is going to return cash to you. Maybe a long time in terms of Berkshire, but it'll be bigger numbers. And those are the coupons, and it's up to you, your job as an investor, to decide what you think those coupons will be, because that's what you're buying, and you're buying the discounted value. And the higher the yardstick goes, and the yardstick is government bonds, the less attractive these other bonds look. And that's just fundamental economics. So in 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year, and a business that earned 12% was a subpar business then.
Let's unpack what he said and make it simple so that anyone can understand this concept. The job of the investor is to choose where to invest his money to get a good risk-adjusted return. The two keywords here are risk and return. The return with the lowest risk, also called the risk-free rate or standard rate, is usually considered to be the interest on the 3-month US Treasury bill, which right now would be 0.84%, and is the return that any investor could achieve with almost zero risk. As you can see from this chart, the risk-free rate changes with time. It went to more than 15% in 1981 and to almost zero in other periods. Now that the risk-free rate is clear, let's go to stock market valuations. Previously, you heard from Warren Buffett referring to companies earning a percentage on equity. He was referring to the return on equity, which is the measure of a company's net income divided by its shareholders' equity. And shareholder equity is simply the company's asset minus the liabilities. As you can see from this chart, each sector has different average return on equity, with a total average of 18%. So you heard Warren Buffett compare the risk-free rate to the return on equity. And he was saying that if the risk-free rate is 2%, owning a stock with a return on equity of 15% is a good proposition. At the same time, he mentioned how when the risk-free rate reached 15% in 1981, a company that had a return on equity of 15% would have been only worth its book value, which is the company assets minus the liabilities.
So in 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances.
So now you know how interest rates affect stock market valuation. Let me know if you liked the video, and I will see you in the next one.